The dollar has been trading sideways as President Trump's tariff threats haven't yet materialised. But how relaxed are currency markets really? This week, President Trump added cars, semiconductors, pharmaceuticals and lumber to the list of products that may face imminent tariffs. But with none of those duties actually yet in place, we haven't seen dramatic moves in the currency markets since he took office. Jane Foley is head of FX strategy at Rabobank. Jane, is this the calm before the storm, do you think?
Well, quite possibly. I think the market has come to learn that certainly a lot of the tariffs that Trump is making, or lots of the threats of the tariffs that Trump is making, may be just part of a negotiation tactic, but nobody can be quite sure. And certainly when it comes to Europe, there is, of course, the risk that tariffs will be coming and could be coming quite soon. But right now, I think the currency market or currency traders are very much poised at the edge of their seat, waiting to see what news comes through and then to what degree that could be pared back over the following 48 hours or so.
The president's tariff plans do seem to be in conflict, don't they, with his stated desire for a weaker dollar. If he also wants to weaken the dollar, how might this play out?
Well, of course, we haven't had really explicit threats about a weaker dollar for quite some time. And in fact, it does seem that maybe tariffs are, of course, Trump's now favoured tool for addressing the US trade deficit rather than a weak dollar itself. We have had some assurances as part of this administration that the US wants to retain the dollar as the dominant currency in the global payment system, as that reserve currency. And that perhaps does reassure markets that a stronger dollar is part of the plan. But of course, this could change. And we know that Trump can be fairly erratic and perhaps it's sometimes even inconsistent in some of these market implications for these policies. So we do wait. Now, if the Fed does want a weaker dollar, well, it's difficult to know how he could do this without forcing the Fed to cut interest rates, something which would really affect, of course, the independence and the credibility of the Federal Reserve. So that's something that the market right now is not taking very seriously.
Yes, and we heard last night in the minutes of the Fed's last meeting that interest rate cut seems further away than ever, doesn't it?
That's exactly right. I mean, if we look at the CPI inflation data, the last release that we've had from the US, what we saw signs of stickiness there in core inflation. And interestingly, of course, the January data really refers to a period before Trump's policies have had a chance to take effect. So what that's really referring to is the strength of the US economic data through the autumn and those inflation pressures coming through the autumn and into the start of the year too, before Trump's policies taken effect. So yeah, in Rabo's view, the Fed may be able to cut interest rates once more this cycle, but certainly the door to another cut could shut hard if some of those policies regarding tariffs or some of those immigration policies really do lift price pressures.
How is this playing into other currencies then? We've seen a rise in the yuan today. Is that the market pricing out that this is, as you said, a bargaining position and the US and China may strike a deal?
Well, yes, we did have some comments from Trump that maybe a deal with China on trade is possible, the market reacting to that. Now, of course, there are some other elements going on in China too. We have seen, for instance, the tech industry finding a lot of support this year on the hope of cheap AI. There's been some talks, of course, between President Xi and some of the leaders within the Chinese tech industry, and that too has boosted that sort of hope and perhaps the risk that maybe we do see in China, the tech industry providing growth. But the yield curve, of course, is very flat. Consumption is still pretty weak. The housing sector very, very weak. So there are still significant growth threats to come through. So it's not clear that the Chinese renminbi can hold this better tone.
The yen is also up, Jane. Does the market see a rate hike from the Bank of Japan relatively soon?
Well, certainly that is the discussion that has been heating up. Now, many Japanese or Bank of Japan watchers do favour the summer perhaps for the next move. But April has been cited by some, and certainly at the meeting in March and April could give us a little bit more of a feel about how ripe the Bank of Japan is thinking that interest rate hike could be, or how close it could be. Now, certainly we've got some Japanese CPI inflation data coming up in the next 24 hours, which should give us a little bit more of an idea. But certainly certainly if we look through into hopes for the spring wage talks, again, there's an indication that these could be quite strong. And if we look at household incomes too, well, they also are suggesting that a recovery in consumption could be further down the line, just later this year, which again will raise hopes that the Japanese economy can tolerate further interest rate hikes.
That was Jane Foley of Rabobank. Don't forget you can watch more videos on Reuters.com.